Hello, my name is Anthony Sicaro, founder and president of Providence Financial and Insurance Services, located in the heart of the San Fernando Valley in Woodland Hills, California. I'm also an estate planning attorney, and for over 5 years, have been the host of the Providence Financial Retirement Show. And this video is going to be specific to my radio listeners. So if you are a radio listener, thank you for listening to the show and for contacting us and requesting this video. Of course, we're sending this video out as a refresher to our clients as well. So if you're a client, thank you for your business. Thank you for your trust. You know that I don't take it lightly. But the reason for this video is because we have a deadline that's coming up. And that deadline is August 31st, 2020. Well, what's that deadline for? Well, that deadline is for any required minimum distributions that you have taken in 2020, but that you wished you hadn't have taken and that you want to put back. So we're going to spend a few minutes here talking about that, how to put that money back, what you need to know. And then while we're at it, we're going to refresh your memory on the quick required minimum distribution rules under the new Secure Act that went into effect at the beginning of this year. And we'll talk a little bit about transfers of as well from IRA to IRA and so on. So if you are interested in RMDs or transferring or rolling over your money from a retirement plan to an IRA or vice versa, or you're interested in putting your money back from an IRA, an amount that you took as an RMD that you wished you hadn't have taken because the rules came into effect after that, then watch this video. If you are not interested in any of that, you can turn the video off because that's what we're going to be talking about. So let's start with some basics. Let's start with the IRA rollover rules and the IRA transfer rules because I think it's very important. Under normal rules, we have these things called rollovers and transfers, and it's important to understand what the difference is because it can be extremely confusing. A rollover, that term can refer to several things. If you have money in a retirement plan and you want to roll it over into an IRA, that's a rollover. If you have money in an IRA and you take that money out, then the government gives you 60 days to put that money back into another IRA. That's also called a rollover. So rollover stands for two different things, but they have two different rules. So it's important to understand that. So let's talk about the rollover rules from a retirement plan, an employer-sponsored retirement plan to an IRA. Employer-sponsored retirement plans are things like 401ks, 457s, 403bs, TSPs, TS, and so on. So the reality is if you are going to roll money from a retirement plan into an IRA, as long as the money goes from the retirement plan to the IRA, there's an unlimited number of times that you can do that in a year. You're not limited as long as you don't see the money. Now, a mistake that oftentimes people will make when in fact they wind up trying to do this on their own is if they want to roll money from their retirement plan, they've retired or they've separated from service and they want to put that money into an IRA, is they'll fill the paperwork out on their own. And instead of having the money sent from the retirement plan to the IRA, what they'll do is they'll have the money sent to them. Well, by law, then, if you're taking money out of an employer-sponsored plan and you have it sent to yourself, the government has to withhold, or the employer plan has to withhold 20% taxes. So you're only going to get 80% of that. And then you have 60 days to put that money back. Whereas if you have the account, the rollover go directly from your employer-sponsored plan to the IRA itself without you ever seeing it, then there's no 20% withholding rule. That full amount will go from your employer plan to the IRA. So that's a pitfall that we often see people run into who try to do it themselves. But that's one example of a rollover. And as long as it goes from your employer plan to the IRA, you never see it, then you can do that as many times as you want, which becomes important because some people want to roll over part of their retirement plan now and then maybe do part of it later. And there's no problem if it goes from employer plan to IRA with you staying out of it. Right? Now, when it comes to an IRA, you have two choices. If you have an IRA in company A and you want to move that IRA to company B or investment A to investment B, but with different companies, then there's two ways you can do it. You can do it via what's called a transfer, which means the two companies interact with each other. You sign the forms, you never see the money. The money goes from point A to point B. And you can do that an unlimited number of times as well. But where we start to get into trouble is with the 60-day rules. The government says that if in fact you took an IRA, you took money out of your IRA, okay? You have 60 days to put that money back into another IRA, and that's 60 days from the day that you receive the funds. You have 60 days to put that money back into another IRA. Okay? If you don't put that money back into another IRA, then it's going to become fully taxable to you. And if you're under 59 and a half, then there's going to be the 10% penalty. If you're over 59 and a half, there's no 10% penalty, but it becomes fully taxable at that same time. So here's a scenario. You take money out of an IRA, it comes to you. They're not the custodian who sent you the money is not required to withhold 20% like they are if that came out of an employer plan. So you get the full thing. You have 60 days to put it back into the same IRA or a different IRA. You can do that, and as long as you do that, no harm, no foul, it's not taxable income to you. It's almost like having a 60-day loan of your money. Okay? Now, there's a couple of caveats, a couple of big caveats. The one big caveat is that this rule is only one time per year per person. It's not one time per year per account. It's one time per year per person. So if you take money out this 60 days, you take money out of your IRA and you put it back within 60 days, and 364 days later you do it again, that second withdrawal is going to be fully taxable. Once you take it out, you can't put it back in. That's what's called a fatal error. So now that's fully taxable, right? And this comes into play as we look at the rules for this year and we talk about our August 31st deadline. So you have to have this as a backdrop in order to understand how the rules are going to be affecting you. Okay, so that is how the 60-day rollover rules work. And again, if you go from IRA to IRA with you staying out of it, you never receiving the money, you can do that in an unlimited number of times. Okay, so let's talk about the rules. Let's talk about what's changed for 2020. And let me just remind you of the RMD rules really quick. The RMD rules prior to January 1st of 2020 is that if you turn 70 and a half, you have to take this thing called required minimum distribution, RMD, required minimum distribution. And that's really the government's way of making sure that that they start collecting taxes on money that you've been saving tax deferred all these years. And yet, in January of 2020, the Secure Act changed the rules. So now the RMD age is no longer 70 and a half, but is now 72 years old. So if you were 70 and a half in 2019, you're still required to take your minimum distributions just as you always were. The new rules do not affect you at all. If you are going to be 70 and a half in 2020 or later, then your new RMD age is going to be 72. Okay. So, but what's happened is because of coronavirus, the CARES Act came around, and the CARES Act said, okay, for this year, for 2020, you do not have to take a required minimum distribution at all. It's suspended for everyone. If you have an inherited IRA, if you have a retirement plan sponsored by an employer, if you have an individual retirement arrangement that you have, it doesn't matter. If you have an RMD at this point for 2020, you don't have to take it. It's suspended. And at the beginning of the year, they were trying to figure out the rules. And when April or May came around, and the way that they put the rules into effect is that if you had taken an RMD by January and it was in January, then you couldn't undo it. It was too late. But everybody that didn't take the RMD, well, they didn't have to take it. So it really wasn't fair. And this went back and forth in Congress and kind of figure out what to do. And so they recently, about 2 months ago, they recently came to a conclusion that, okay, we're going to make it fair for everybody. We are going to give everyone until August 31st to put their RMDs back if they didn't want to take them. Okay, everyone. So you have till August 31st, that's a week, to be able to put your required minimum distributions back. Now, this violates a lot of rules, so this is an exception. Remember, we said for the 60-day rollover rule, it's only one time per year, right? Well, what a lot of our clients are doing and what a lot of retirees are doing is they're taking their minimum distributions monthly. So if your minimum distribution is $12,000 a year, there's a lot of people out there that are taking $1,000 a month. Well, the reality is if you're taking $1,000 a month and you can only do one rollover per year, well, then even though there was no required minimum distribution, technically you could take one of those $1,000 and roll it back into your IRA because you're allowed one a year, but with the other monthly distributions, it wouldn't help you at all. So the bottom line, without getting into the weeds more than I have, is that if you've taken an RMD this year at any point in time or in any quantity or in any number of RMDs, normally you could not put those back. Okay, but this year you can. You have to get the money back in by August 31st. That's the deadline. What if you miss the deadline? Well, then there's another deadline. And that other deadline is December 31st. And what you can do by December 31st is you can take that money, that RMD, and you can convert it to a Roth IRA. And when you convert IRA money to a Roth IRA, you have to pay the tax on the conversion. And when you put that money into a Roth IRA, that's now going to grow tax free for the rest of your life. If you're going to take an RMD that you don't want, and you got to pay tax on it anyway, you might as well convert it to a Roth. Now, in future years, you cannot do this. This is only applicable for 2020. You can never convert an RMD to a Roth IRA. You can always take out more and you can convert the excess to a Roth IRA, but not the RMD. Well, this year, the CARES Act waived the RMD. So when you took money out of your account, you thought it was an RMD, but it's not an RMD because there is no RMD for 2020. So you can actually convert it. And I've had conversations with a lot of clients that that's what they want to do. They say, look, Anthony, I'm used to taking this money. I realize I don't have to take it. I could put it back, but I'm used to it. Why not just take it and convert it to a Roth? It's a one-time shot that you get. I'm all for that, depending on your situation. I think that makes sense. Now, before August 31st, you have the choice. You can put the money back into an IRA and just pretend the RMD or pretend you never made a withdrawal at all. That's what's going to happen. And it's a non-taxable event. You took this money out, even if you took your RMD or what you thought was going to be your RMD in January, and by August 31st you put it back. That's non-taxable at this point. Um, and uh, and so you have till August 31st to do that, or until August 31st, you can also do your conversion. But the nice thing is your conversion you actually have until December 31st. So if August 31st comes and goes and you didn't watch this video by then, now it's after August 31st, you're watching this video, you still have till December 31st to convert that money to a Roth IRA if you want to. So again, I hope this information has helped. Puts a deadline on your plate. We don't have a lot of time. I encourage you to take advantage of that. If you have any questions about this video or you want to know logistically about your situation, every situation is different. Feel free to contact us. Our number is 818-887-6443. We can certainly schedule a quick 15-minute call, and I'd be more than happy to talk to you or answer your questions about that. But wanted to give this information to you. Again, thank you for being a loyal client, and thank you for watching the Providence Financial Retirement Show. God bless.